Hi, Steve Van Metre here, and welcome to your Monday night premiere. We take about 15 minutes every Monday and Wednesday night trying to make sense of some markets that, well, may not quite make as much sense as I thought. Now, today's topic I want to talk about is the real reason interest rates are falling. But before we get to that, over the weekend, we heard President Trump, Larry Kudlow, and I think Kellyanne Conway all come out and say, we're not in a recession. There won't be a recession until 2020, which, of course, some reporters pointed out to Kudlow that, well, didn't you make that call in 2007? Pretty bad timing. Look, the top, whether it's the government or anybody on the top, is never going to tell you there's a recession. And I'll prove it to you really quickly. Let's say President Trump came out and said, we will be in a recession within 90 days. Now, what would be your initial reaction? Would you go out and buy a new home, buy a new car, finance a bunch of stuff? Nope. You do the exact opposite. You're like, oh, we're going to be in a recession. You'd sell your stocks. You start hoarding cash. You stop spending money. You wouldn't finance anything. You stop eating out. All of a sudden, everything would change. And that notion, that lack of confidence, that lack of faith would put us in a recession. So the reason that you'll always hear people at top that will never call a recession is because as long as they convince the public there isn't a recession, then people will, buy new cars, finance new things, go out to eat, and spend money. And the notion that money being spent in the economy could starve off a potential recession. Now, it can't stop one, but that's why you never, ever hear them say, there's a recession coming. It's a confidence game. The content of this video is provided as educational information only. It's not intended to provide investment advice. This material is not to be construed as a recommendation or solicitation by a security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre in own personal capacity. The opinions expressed in this video that do not reflect the view of Atlas Financial Advisors, Inc. or Steven Van Metre Financial. Now, I know lots of people wake up in the middle of the night with various things on their mind, and just because they wake up in the middle of the night, and of course, some people wake up because they have shaker mares, which is a great joke that my wife will get a kick out of, and unfortunately, no one else will. But I wake up in the middle of the night thinking about bonds and interest rates. I know, I lead a pretty boring life, as you can probably figure out. And Friday night or Saturday morning at some point, that was on my mind. And the reason it probably was there is because some people had asked me last week is, can interest rates go lower? And the answer is, yeah, they can. Alan Greenspan said last week that yes, he saw no reason why interest rates in the U.S. couldn't go to zero or even negative. After all, they have been negative, or they are and have been negative, in other countries. So there's no reason they can't. Question always is why? So we've seen long-term interest rates fall very rapidly against short-term rates. One of the questions as an investor always wants why? I said, okay, well, why are 30-year yields falling? And it occurred to me, well, what are 30-year yields a proxy of? What do we have? Do you even know why we have 30-year bonds? We have them because we have 30-year mortgages. The reason we don't have 50-year mortgages, we don't have 50-year government bonds. And if we had them, we probably would, because if you have a liability in our banking system, you need to match it with a nice, safe, and sound asset, which a treasury bond is. So I thought, well, wait a minute. If 30-year yields treasury yields are really a proxy of the housing market, is there a way I can find out what kind of bonds or can I find out if the large banks are holding mortgage-backed securities? And the answer is, yeah, I can. And so here's what I did Saturday morning when I got up, went to my computer. I know, again, lead a pretty boring life. And I pulled up the data from the Federal Reserve website on Treasury and agency securities of mortgage-backed securities at all commercial banks. Now, I inverted them, so this blue line is upside down. So normally it's rising. In fact, it's at its all-time high right now. And then I took 30-year Treasury yields in red, and I overlaid them. Now, the reason I'm not going back further is because there's not a whole, you can see there's no data on banks holding treasury and agency mortgage-backed securities. So we got to go with roughly the last 10 years, which is pretty good. And what you can see over the last 10 years is that as banks take on more and more mortgage-backed securities, which again, this is showing inverted, interest rates go down. Now, a lot of people don't understand that. They think that the more debt a government issues, a higher interest rate they must pay. It's the exact opposite. The more debt a government issues, the lower interest rates go, because when they borrow from the public. The public must lend them the money, and when they do that, it pulls money out of the economy, goes through the inefficient government system and comes out the other side. So a dollar in is not a dollar out. It's always something less, and so it's very inefficient. So the more government borrows, the more they crowd out the wealth generators in the public sector, and you get lower economic growth. This is part of the reason back. You can go back and look at when the boomers entered the economy. Really, you're talking 70s into the 80s, and when they really were just, making things happen. There wasn't a lot of debt, and they didn't have a lot of debt, but the government didn't have a lot of debt. So, interest rates did go up, but today they're going down because as debt goes up, interest rates fall. Now then you start thinking, okay, well, wait a minute. So the banks are adding mortgage bonds, so interest rates fall. Well, yeah. Well, why? Well, here's my opinion on that. Where are these bonds coming from? Well, they're coming from the Federal Reserve. And which bonds are these that the Federal Reserve bought? Well, the ones they bought off the banks back in 2007, 8, and 9, and they're following the junk, garbage mortgage loans that nobody wanted. Not even the banks who originated the loan. Yeah, we don't want that trash because we actually know what it is. So they offloaded to the Fed, and the Fed was happy to buy it to unfreeze the banks who just wouldn't lend. So now the Fed is dumping them back. Now, the Fed never thought they would actually keep them this long, because the plan for the Fed was, well, we'll lower interest rates, and then all these people go and refinance their loans, and they'll disappear off our balance sheet and back onto the banks. Yeah, that didn't work. It works really well, say, when interest rates are 10%, you lower them to 8%, but when they're 4% and you go down to maybe 3%, there's just not enough interest margin there to do it. Plus, some of these homeowners may have been upside down. Plus, some of them may not even be able to qualify for another mortgage. And it's also possible that getting another mortgage wouldn't actually save them any money. So now the Fed is dumping them back onto the banks, and these things are garbage. So what do the banks have to do? Well, one, they have to hedge them. They have to spend some money to hedge against changes in interest rates. Because think about this. Let's say you owned a 30-year mortgage, right, that you bought as an investment. Well, if interest rates go up in the next 30 years, which is highly probable because, we have to assume that could happen. Because if they went down, it wouldn't be a problem. But let's say interest rates went up. That means you lose money. So how do you protect yourself? Well, you would need to hedge that. Perhaps you would short the bond market to protect yourself. You would do things to make sure your money didn't disappear. So why are interest rates falling as banks are taking on more and more mortgage bonds? Well, simple. The banks are still lending, but they only want to lend to those who have really good credit, really good jobs, and money in the bank. And because there aren't very many of those people left, what happens? Interest rates go down to find them. See, falling interest rates mean financial conditions tighten. It doesn't mean banks don't want to lend. It just means they want to lend to their most credit-worthy customers, who after 10 years in this expansion, they don't really need anything. Hence why we see in this chart, interest rates are going down as the amount of mortgage bonds going to the banks increases. Now, the beautiful part of this is the Fed said when they end quantitative tightening, and they did at the end of the last month, they were going to continue to unwind their mortgages and their long-term treasury bonds and dump them back on the bank balance sheets because they didn't want them anymore. So guess what? The Fed is still tightening indirectly, putting mortgage bonds on the bank balance sheets, which is causing interest rates to go lower. And as the banks go and try to find really credit-worthy customers that want to borrow money, because they don't need any more garbage loans, they've got plenty of them. They want good loans from good credit customers. They can't find them. So interest rates go down. So interest rates should continue to fall. Now, moving on from that, starting at some point next month, the Fed or the U.S. Treasury is going to borrow an insane amount of money, $350 billion over a 2-month period. And we can see that looking at these blue spikes on this chart here. Now, I've overlaid 10 and 30-year Treasury yield, and I just wanted to look at this just to get a feel for, we've had this rapid drop in yield, and I think it may be a little too much too fast. I'm not completely surprised by it, but I expect there to be some sort of fight back from the speculators, and we'll look at that shortly. And what we see the last time we saw the last 2 times we see kind of a big lending binge. Interest rates did go up briefly, and then they went on a long down cycle. And we see here they kind of went up as people didn't believe. And as part of this is the people in the market don't believe that, well, if Treasury's borrowing all this money, interest rates have to go up. Nope. And what happened? Interest rates went down. We're also dealing with the 18-month lag in monetary policy, so that's kicking in as well. So all this tells us is there ought to be a backup in yields. This is kind of what I've mentioned, and this is where I'm going to make that final tune on the portfolio, pick up some zero coupons, swap out the short-term treasuries or treasury bills for long-term bonds. There's a reason to do that. And again, think about this. When the Fed was doing quantitative easing, I may have mentioned this Friday or some in the past, but it's worth repeating. When the Fed did quantitative easing, what did they do? They bought short-term treasury bills and pumped the banks full of cash. What was the net effect? Short-term interest rates went down, long-term interest rates went up. So what is going to happen? Well, most of this $350 billion the Treasury is going to borrow is short-term bills, 52-week and under, as far as I can tell. So what they're going to do is they're selling bills, okay? Opposite of QE, this is QT, quantitative tightening. What should happen? The exact opposite under QE. Short-term rates should rise. I don't think they're going to rise a lot, but they should rise. And long-term rates should fall. See? Market's completely mispositioned, and I'll show that to you momentarily. Let's take a look at the NASDAQ. The NASDAQ McClellan Summation Index is showing liquidity is still dropping, although the market is trying to rally, mainly in overnight, because during the day there's just no liquidity. It just can't seem to gain traction. This is not saying there's a bottom in stocks. It needs to really get down low before it indicates there's a potential bottom, and it doesn't mean there is one. It just means there's a high potential for one. Now let's take a look how the hedge funds managers are positioned. And I told you I was going to get really excited if this came out the way I'm seeing them now, because what this reflects is as of August 13th. Now on August 13th, that was last Tuesday, and we know yields were already falling going into early last week. And I was like, I was thinking that, man, if the hedge funds, the speculators, are still net short, there's a reason how interest rates are going to get to zero, because they're going to have to buy bonds to cover their short positions, and you still have all of the money. I'm sorry, I thought you were looking at the chart. There we go. All of the money sitting out there, and I was looking at my keyboard. All the money sitting out there from retail investors that are not in bonds. Pretty cool. So here you see net short. Bingo. Totally on the wrong side of the market. 10-year treasury yields net short. 30-year went even deeper short. You can tell they're totally on the wrong side of the market. So they're doubling down, trying to turn their position around. The market will see this, probably see yields try to back up a little bit, but these people are totally wrong. Looking at crude oil, they're long. That's why oil is trying to climb still despite heading lower, because there's so much speculative money long oil that if this ever were to reverse, you're going to see oil prices tank. S&P 500, they didn't really change their position after getting kind of whacked after being a little bit long there, so they scaled back some of those longs. And let's take a look at gold. Now, this is not looking at all positions, just looking at one of the largest of the speculative positions. But when you look at all position, you have the longest long in history of gold right now. And when you get overcrowded on one side and you have a net equal short position on the commercials, you'll end up getting a reversal. That's the gold position. That's when you want to look to buy it, is the unwind to the next one, because now that we know that's flushed out all of the buyers. NASDAQ 100, they're still long there as tech stocks come down, and they're on the right side of the Russell 2000, which is looking like it's going to just take a major drop. And then they're about the same long on the dollar. They backed off their volatility shorts, but I'm going to guess as of starting this week, at least based on what I'm seeing this morning, they're going to be increasing those longs. All right, so we've got not much time left. Let's go and make sure we're all there. S&P 500 trying to get back up to resistance here. I think it does. The key to watch is not the S&P 500. It's watch Apple, because Apple's got a big position in the S&P. This is its sell zone. So Apple has large sellers everywhere over 210. So you get up here at 210, this is a selling top, drove prices down, get up here, sold in this shaded band, sold again. I was watching today, I was trying to rally and did in late trading. Looks like, in late trading it came back down after going up in early trading. So this, you want to know what's going on in the market, watch Apple. This is a bearish pattern. If sellers continue to dominate here, eventually stock prices will indeed head lower. So as far as the bond market goes, I still think the long bond, this is 20 plus year treasuries, I still think we get down into here. That would be where I'd look to rebalance the portfolio as a 50-day moving average heads up. So let's wrap things up. I'm Steve Van Metre. Thanks for taking your time to watch, and we'll be back Wednesday with, whatever the market brings us to talk about then. Have a good evening.